those of you that don't know me, my name's David Pegler. I'm sort of a medium to longer term, longer term trader. It's a fractal sort of volatility 3-part model that we use. Looking at multiple time frames, trending and episodic volatility through equity markets, and then looking at correlations thereof, and then trying to figure out rates of change on the macro side to place different trades for different environments. So like always, if you have questions, fire away. The only way that I know we're paying attention, actually getting something from this, is through questions. So it really is open today. Anything's on the table and we can talk about it all. So let's let's try to figure this out together. I wanted to mention, it's so funny, I looked at CNBC this morning and they had a headline about CNBC is the biggest waste of time for economic news. It really is. It's old wall, sort of shoving old wall information down your gullet. They were mentioning how things have drastically improved in the employment markets. Only 740,000 new claims this morning, everyone. Now, there's still 24 million people, 25 million people claiming some kind of unemployment. Now, the part that's interesting to me is, and welcome everybody, I know you're kind of filtering in here. We're going to talk about the dollar as best we can today because we are right there between a very critical little stage on the euro, whether we're going to see sort of 105 or 125. We're going to need to figure that out ASAP. I just wanted to talk about the jobs thing at the moment just for a minute, because really our question is, as far as the dollar, is inflation or deflation? It's really that simple. If we're in an inflationary environment, the dollar gets obliterated. If we're in a deflationary environment, we're going to see more dollar strength that rattles people that they don't expect. You wouldn't believe. And there's cases for both, and we sort of have to figure that out as we go here. I have a few little key markers and trend change points that I have in mind, particularly for oil. We can look at different volatility regimes and try to figure that out. I want to mention this first, is that the key metric that I'm watching in terms of rate of change right now is the permanent job layoffs. And they're starting, before, when COVID hit, and by the way, we were starting to get soft in Q4 of 2018 on this market. It's a wonderful thing that the politicians in this country have done, is they've shoved it down the American public's throat that the stock market is the economy, and macro tourists probably think it is. But it's not, and things were getting squirrely in Q4 2018, and then have continued, and then the virus kind of kicked things off. But in America, the white-collar layoffs are now starting to kick in big time, all right? And if you talk to hiring managers, they'll tell you Zoom's a wonderful thing, but what they're starting to see now is, if you go to an office environment, everybody sits around, and the work is sort of a collection of what everybody's doing. And like I said, welcome everyone. Please fire away with questions. It's the only way I know that we're kind of touching base on something meaningful. I don't want you to walk out of here and not have a full understanding of the game plan, at least moving forward. And so hiring managers are able now to determine who's actually productive and who's not, because they have a return of work coming from remote locations, which they didn't necessarily have before. So that's interesting. So we're starting to see white-collar layoffs that we weren't before. And remember that stimulus doesn't help those people because they earn too much money. If you earn $90,000 or more, you don't get the stimulation that the government is handing out or potentially handing out. And that goes to, the people that were earning less than that a year ago, right? Because it's based on the previous year's tax returns. So white-collar layoffs are going up. And you've got to remember that 40% of America are white-collar employees, and they account for 61% of the consumption. All right, so if we're starting to see a spike in white-collar layoffs, consumption is going to fall through the floor. That's incredibly deflationary. All right, and just to give you some measure of, it's an unrelated subject, but we are now at non-financial debt at 94% of GDP. So companies are taking on crazy amounts of debt and falling further and further and further down the ratings board. All right, and we are now at the lowest percentage of the lowest percentage now of lean recovery monies. All right, meaning this is that if you're a junk bond holder, you are going to get 15 cents on the dollar for high yield bonds, and 47% as the actual lien holder. It's never been lower. All right, and the economy has never been more leveraged. These are very deflationary things, and it's something to watch moving forward. All right, so I know that most of you don't care about these things, but this is going to be the crux of what is inflationary versus deflationary, because I think that the economy is moving into a situation where we are either going into a slowing growth deflationary period, all right, in which case tech, gold's going to do fine. In which case tech and things like Bitcoin are going downtown, dollar getting strong. All right, industrials going to get crushed. Financials have been weak all year. All right, or we're going into a situation where we're going to be inflationary, and then we're talking about tech to the moon, Bitcoin to the moon, dollar gets killed, and we're right there. We're right there between that line, and it's literally 50-50 at the moment on an economic basis, which is going to determine where the dollar goes. All right, now, all that in mind, let's get into the weeds of it. I wanted to show you a couple of things. One is this. If we, I think it's interesting to note that the dollar and commodity correlation has been very strong this last week and a half, but the dollar to equity correlation is completely broken. I don't know if you guys have noticed that. And we got to see if that's sort of an episode of break in correlation, or if that's something that's going to continue, because a lot of what we do as traders is sort of mean reversion stuff, isn't it? Correlation's been X, it's now Y. Is it going to return back to X, or is this a change in theme altogether? And difficult. It's very difficult at the moment. Anyway, so I want to show you oil first, because I feel like if we can figure out oil, it's a little bit of a canary in the coal mine at the moment. Yesterday we saw oil down, but the dollar up, and then overnight, obviously, a little bit of dollar strength. But here's our oil chart, and zooming out on the daily, you can, Ray Charles can see what this 42 means. All right, and we just sort of lurking below that. And nat gas has obviously been very strong, copper very strong. And copper is a story of the dollar, but it's also a story of China, which is definitely an expansionary, inflationary phase. China's metrics are completely different to what's going on in the US. And there's an argument to be said that you cannot trust the Chinese data, and you're right. But when one's dealing in rate of change, you have the rate of change relative to the data that's provided, right? That's what we make decisions on. Whether the data is accurate or not, it's almost irrelevant. Something to think about. Anyway, so this, remember, as a rule now, that in inflation up, dollar down. Okay, and vice versa, inflation down, dollar screaming to the upside. Now, my opinion is that despite the Fed, despite all of these mad central banks, we are going into a deflationary period. And that should mean dollar strength. But I'm also not silly enough to think that if we start to break out, we could see another leg up in dollar weakness. That's a problem for that thesis. All right, now. Oh, one more thing while it's on the top of my head. And I'm sorry for jumping around. There's a lot to consider in this analysis is capital gains tax. If people have had a phenomenal year, which a lot have, thank you, Jay Powell, I don't think Jay Powell can buy stocks going into the new year. That's going to be a problem politically, but I think he probably can next. I think that we could see a wave of quote profit taking at the end of the year so that people don't have to pay capital gains for next year. And that's also a little bit of a deflationary push on the market. Just something to put in one's back pocket. All right, so here's oil, and I'm watching oil because of this 42.50 area. If that meaningfully breaks and breaks ahead of, say, the euro getting above 19, I don't think there's anything really then to stop euro going into the mid 120s. And if that's the case, you know, we're seeing oil way back at sort of 48, 49. All right, and so it's going to be very difficult for me to pile on euro shorts if we are starting to close stuff above 48, or 42 rather than oil. What I do expect, however, is sort of a fake break. I think that this could push above it, say, I'm not feeling that, and then we settle something like that. So if you start to see oil volatility rise, so if you start to see oil volatility rise while oil volume decreases while we're breaking this, you know that that's a fake break. You know, and that's just a good rule of thumb for anything, right? If you have volatility rising, okay, while volume is dropping, all right, you know generally, and price is rising, that's the key element of this, all right, and price is rising, you know that that is a short. These are just good rules of thumb, by the way. So volatility rising, volume dropping, while price is rising, that is a short. Okay, and said differently, if volatility is dropping while volume is rising, while price is rising, that is a sustainable breakout and price will continue to the buy side. All right, or if price is dropping in the context of a trend while volatility is while price is dropping, all right, if volatility is dropping and volume is dropping, then you know that that's also a buy. All right, there's a few little rules here that you can look by, and this is very basic stuff. Hooray for particularly equity markets. But these are things you can look out for in the gold markets and the, you know, if you're looking at gold volatility, GVX, if you're looking at NASDAQ volatility, VXN, if you're looking at S&P 500 volatility, VIX, obviously you guys know the VIX. All right, so these are just basic rules of thumb. And it's something that we need to watch concretely when oil is going to challenge this. And it looks like it will. All right. I know a lot of you are joining. Please ask questions as we go. It's the only way that I know that we sort of paying attention and getting a little something from this. So let's pull up a euro chart. Okay, So here is our very expanded Euro USD. Now, currencies are traded relative to each other. And the Europeans have not had a great tourism year. And by not great, I mean apocalyptically bad. Lagarde has come out and said very staunchly that we want to devalue the currency, blah, blah, blah. But it really is about US consumption. Anyway, so I don't think that we can just roll right through this stuff. We can look at the dollar index as well. I can pull it up very quickly. Remember that the dollar index is 60% euro. Welcome from Brazil. You're speaking to me in a very swampy Savannah, Georgia today. Hey, Matt. Very swampy. Let's pull up DXY for argument's sake. Right, now, and really the question that we're trying to answer to ourselves here, where are you located, Matt? The question that we're trying to answer to ourselves is Euro 122.5 or Euro 115 first stop. And the issue is this for dollar bulls is just the gap to this next meaningful support. It's way down there, you know. You start getting below 92, 90, 93, and there's a lot of fresh air there. It's really the same for euro. Nonetheless, I'm a dollar bull, actually. I think that we're going into a deflationary period, which I know is a contrarian view. Anyway, let's go back to this euro. Now, I don't think anybody would be surprised if we went up into this stuff here and then, you know, all the way back down towards 110. I mean, if for whatever reason on the long-term basis in a couple of months, you're sitting in the mid-120s, you got a fantastic short there for the better part of 1,500 pips. I mean, are we in debate about that? You know, even if this turns into a cup and handle situation, so, you know, we go up here and everybody's looking at this thinking, well, this is a cup and handle. We're going to do something like that. I mean, you still have 1,000 pips short. But I think ultimately that we're probably going to try and sort of do something like this and go and test 95 cents. It'll shock the world. The Fed will just crank up the printing press like you've never seen. The Bitcoin bulls their heads will explode. Because the stock to flow chart's calling for 100,000 on Bitcoin like soon, like next year. And I am a Bitcoin why it's Bitcoin bull, but I don't think we're going to go straight to sort of 27,000. I just don't. I think there'll be a revisit to 9,500 for buying opportunity there. Anyway. So what I'm thinking is a little something like this. You see this weekly stochastic still hard down. While it's crossed, pay no attention to that. That is a down pointing stochastic. And I see this as a lower high. All right, in which case, lower high typically predicts a lower low, in which case I think that we're in a mode of sort of doing something like this. and then we go test that 122 stage and down. All right. And it's all fractally based analysis. Can I look at the Brazilian? If we, sure. I mean, I'm not sure how many folks are trading, but yes, I will swing over there towards the end of the lesson if that's all right. Let's look at the majors first, and we'll go look at some Brazil. I haven't done any analysis on myself, but I'm happy to. And I have a sneaky suspicion that if you are familiar with the Aussie or any EM currency, that the real will look pretty similar, to include the South African rand. And obviously these are currencies that are hyper rate sensitive because of huge dollar denominated EM debt burdens. All right. So yes, I will happily go look at that. Anyway, so here's our daily chart, right? And obviously the bulls are looking at this thinking, okay, buy side. Our daily central pivot is 1792 today. Let me pull up my little downside risk range here. Yes, 1680. We're in the middle of the range here. I know it's support, but it really is in the middle of the range relative to the volatility. I'm expecting sort of something along these lines. Given the daily lower high, the fact that this 4 hour is pointed down in correlation with the weekly, I'm anticipating we do sort of something like this. Lots of support around 1760. The weekly central pivot is 1744. So I could absolutely sort of see something along these lines. And we push down. I don't know how you guys feel about that. But David, we're going to get stimulus. Probably. But you just can't live your life. You can't have a volatility model. You can't have a support and resistance technical model, a macro thesis, and be worried about. Admittedly, it is $2.1 trillion lurking out there. But I'm willing to sort of work around it a little bit. Anyway, so this would be my plan here. I'm more interested in taking the short side just because I think that on a daily basis, we are probably trying to do something like this. All right. And in which case, we're putting in a lower high. Now, obviously, if oil goes and comprehensively breaks 42 on a high, on a dropping volatility, on a high volume day, and we start to see euro above 19, well, then this is garbage. And then we're doing this. And you need to get on that train, and we're off into the mid 120s. That's the contingent plan. But I think, I believe that this is a daily lower high. I think we've come off the resistance. I think that the dollar index has come off the support. I think we're going to start to see a little bit of deflationary information coming through. And Lagarde kicks in and actually tries to devalue the dollar. For the Europeans to be able to survive and export their way out of things. Sorry, I just missed a question on the Q&A. Are you speculating on the election? No, I don't care about the election. Couldn't care less. No, to be honest. Sorry, Jim, the question is, am I speculating on the election? And it's really isn't that it's sort of a defeatist thing to say? I just don't care. I think that we're going to be, I think Donald's going to win by a landslide to begin with. But I think it'll probably be business as usual. Fed monetizing a bunch of debt until it all blows up, basically. Look at this on the short term. So I think you can build a plan for shorting euro between 1860 and 1880 with the idea of taking that down towards the 114, 115 range with a lot of noise in between. You know, or if you are a bull, and I do see the case for that, this early mid 17 zone should at least give you 80 pips of upside, and then you can figure out what you want to do. If you want to hold that to the 122.5 range, you know, you think you're going to break a higher high and oil's going to take us with it and off it goes, then that's cool too. So, you know, my plan was a short through here or a buy through here, and this would be a trade. Remember, trades and trends are different. Trades are sort of 1 to 3 days or 1 to 3 weeks, depending on what you're doing. And trends are 30 to 90 days. Okay. And so I have a thesis of deflation, that we've made a lower high, that the next level down on a daily basis would be 115, 114 area. And this sets up sort of a high, a medium, I'm going to call it medium probability trade, because we have a lot of risk out there. And but it is a low risk, lots of reward setup. All right, so that's what I'm thinking on the euro. And then on the longer term, a 114 to up to 122, and then all the way down to parity kind of move going into the first and second quarter of next year. And then the dollar just gets obliterated into thin air, and we see Bitcoin take over as Bretton Woods 2.0 and see blockchain just take over the universe. But that is for a different discussion. All right, we have 15 minutes left. Let's have a quick look at some equities here, shall we? And then we'll go look at that real chart and some other things, unless you guys want to look at something else. Any questions on that euro? I know a couple of you kind of logged in here a little late, and we talked about consumption and unemployment and permanent job losses and all different things. I also want to mention again, and I seem to mention this in all of my webinars, is that here in the States, we have 9,000 people retiring every day. Baby boomers. Our demographics are horrendous. And we don't have much immigration to offset that. Well, consumption has a very big role. Demographics have a huge role in consumption. And similarly said, have a huge role in inflation and deflation. And in this case, I think it's all deflationary, despite the Fed sort of monetizing all of those losses. Debts. All right. Anyway, also a subject for another day. Let's go look at the pound quickly. You're going to hate me. I'm going to go back to the NASDAQ. The reason why this inflation deflation thesis is everything at the moment, I'm talking everything, is because tech does very well in a stagflationary environment, very well, extremely well. We saw that last quarter, right? We had slowing growth, but higher inflation, tech explodes. But if you're going into deflationary slow growth period, tech gets killed. So, this is a big deal relative to that thesis as well. Okay, and this to me is looking like a step down scenario. Oopsies. You know, a little bit of a step down, and that's deflationary in my mind. You know, on the very short term, though, that's obviously not what one's expecting here. I think that this is a long, maybe all the way up into the 11.8s, 11.9, and then downtown. But tech is another one to watch as a leading indicator potentially for the dollar, is what I'm trying to get at. All right, quick look at pound, and then we'll run over to the Brazilian real just for interest's sake. So the big takeaway from the pound right now is that we're in the middle of this larger range, obviously. We get rid of this trend line because that's pretty much invalidated. But on a bigger sort of on a bigger fractal basis, I think we can all admit that 120 is the low and 134, 135 is the high. And we're sitting pretty flush in the middle of that. And if we zoom a fraction, you know, we really in the middle of even this little range. You know, we have a bunch of stuff up here, but this is a tough spot to do a whole lot on pound. Right? I like to sell at extremes and buy at support at extreme, you know, sell at extreme highs, buy at extreme support, and the pound is right on the middle, which means that your probabilities become a little weird. All right, that said, the reason why we had the short on yesterday was 31.74 weekly R2, and we hit that pretty early in the day yesterday. And anytime you have time of day on your side and you're hitting sort of weekly extreme pivots, you're probably going to see a rejection there. And at the same time, you know, we had things like the VIX hitting the early 20s, which has been, the late 20s, which has been their upside volatility regime resistance. That's another discussion too. This is looking very much like a lower high relative to the previous high on a daily basis. And I would have no problem sort of thinking something along these lines on the short term. A lower high around 31.40, trying to take that down towards 129, just essentially retracing the entire move of the week up. And then honestly, I'm not sure. I think pound could just be messy. And, you know, ultimately, I think that we're probably stepping our way down here towards 125 again. But in this very short-term basis, messy. And I think you can see why. It's just in the middle of the chop, you know, likely to come down, bob ourselves up, then move all the way down and step down. So you're going to have lots of bounce opportunities. So it's probably good trading, but not something you necessarily want to hold unless you're trying to take shorts towards the late 131s, I would think. And then you got a good chance to survive that and stay in profit the whole way and just have a very thick skin and try and take that down towards the early 120s would be my guess. All right, so let's look at this Brazilian currency for argument's sake. Any questions on this euro and the pound? Any dissenting voices? I'm all about a dissenting voice. I'm quite happy to have differences of opinion. You know, you're talking to a dollar bull, which I know is a contrarian position. So So I think Europe's just in not great shape, and I'm quite happy to play the whole thing from short the euro sort of standpoint, and then just trade around the pound. Yeah, so the remark is that there's multiple factors, and I think this is Brexit. We've been dealing with Brexit now 3 or 4 years. I thought Brexit was supposed to make things better. Brexit was meant to make things that much better. Why wasn't it an easy transition? Never mind. I don't know. I don't really get it. That becomes a political discussion. So it's a difficult question because you've got to remember with currencies is that it's not just about the headwinds for the euro, and it's not just about the headwinds for the pound, and it's not just about what's good and bad for the dollar. It's about what's happening relative to other currencies. And it's as simple as this and as complicated as this. If you can solve the short-term to medium-term inflation puzzle for the dollar, then you can build a thesis for everything else. The only environment, it doesn't matter whether it's a high growth, high inflation period or a diminishing growth, high inflation, in other words, stagflationary period, the dollar doesn't do well in those environments. So increasing growth, increasing raised interest rate, dollar doesn't do well. The only environment that the dollar really does well is decreasing growth, decreasing inflation. So to simplify matters, figuring out rates of change relative to consumption is the big element of the dollar in my mind. Revenues are dropping, but the Fed's obscuring things. And then the narrative, if all of a sudden we start to get a bunch of dollar strength, the narrative will then become, oh, look at how Brexit's killed the pound. Or if we start to see a bunch of stagflationary pressure here in the United States, in other words, slowing growth, but prices are rising, and then the pound is now at 140, the Brexit narrative will be, hey, look, the UK economy is doing extraordinarily well. The pound currency is at 140. So the narrative will change relative to what this dollar thesis is. All right, so in my mind, the top side of the pound is sort of 32.5, and the downside is 120. And at the moment, I see us as having, a couple hundred pips of upside and about 1,500 of downside. And some holding shorts and just trading longs. I hope that makes some semblance of sense. And I'm sure I offended a bunch of people with the Brexit opinion. But c'est la vie. Just say something in life. And then the remark about it is a multiple factor. And for me, one has to have the fractal view. Even I don't care if you're trading on a 1-minute chart. It is imperative to have the fractal view. In other words, if you're lost in a jungle, you don't go down and look below the leaves. You try to climb a tree and look above it over the landscape and get an idea for where you're going. It's the same thing with technical analysis. It's the same thing with volatility analysis. It's the same thing with macro analysis. Rates of change, looking at the big picture and then boiling it down. Mandelbrot was a genius. I mean, my first impression with Israel, I don't see any reason why it doesn't continue to depreciate. This, if anything, just looks like a continuation flag, I would think. Like I said, all the EM currencies are very, very, very rate sensitive. Huge dollar-denominated debt burdens. The price of the dollar, or rather interest rates around the dollar go up, the cost of the dollar increases, that debt servicing skyrockets in dollar terms, and now you're printing big time domestically if you South Africa, Brazil, Argentina, Australia, India, and you'll see those currencies just get relatively very weak very quickly. All right. So, this looks like a continuation to me. Potentially 530 up to 6.5. I see no reason to think that trend is going anywhere but up. All right, guys. Well, I hope you learned a little something there. That's it sort of jumped around a lot today, but such is life. This is a complicated environment. We were less than 2 weeks away from the election. There's $2.1 trillion of stimulus just hanging out there. So keep your head on a swivel. I can be reached on the twit at ForexDavid, Forex David. Probably the best way to get a hold of me. You need to, if you want to run an idea. Otherwise, have a great day. The question is, brief us on the stimulus. I don't think that we can, as traders, really, because it's just going to chop and change. It's going to be politicized. So there's a little question in private. Please, a quick brief on the stimulus. It's going to be politicized out of sight. So if you want my honest opinion, I think it fails here today and tomorrow. And then Trump does what he does best. He creates a problem that doesn't exist and then solves it and comes out smelling like roses. So what I anticipate is it fails initially. The market goes, oh no. Nobody ever stops to say, why do we need stimulus? If the economy was doing so great, you keep telling us it is. Why do we need stimulus? Well, because it's terrible. 26 million people filing some form of unemployment. Permanent job losses skyrocketing. People are realizing they can do the same. They can produce the same amount with less people. That's dangerous. And I fully expect it to fail at the deadline, and then we set another deadline, and it succeeds miraculously. And we'll see a big day of dollar weakness. We'll see a big jump in the stock market, and all those things will be sold into. Meaning that we sort of see a move to 17 on the euro, and all of a sudden we're back at 19 or 1880, and it's all sold into. So I don't expect a sustainable move out of it. It'll be noise, lots and lots of noise. So be very careful, trade small, be very, very, very patient about where you're picking off your trades. Okay. Oh, I mean, it's complete manipulation, but it's nothing new. And, I am very politically agnostic. I truly am. I don't care. I live in Georgia, so it's a very red state. I get Trump shoved down my throat all the time. And I get the people here saying, but look what he's done for the economy. And I say, okay, that's fine. But we have printed $7.2 trillion. We have a rate of change of 25% increase in the Fed balance sheet. I mean, the Fed has bought so many treasuries. They need the stimulus bill just so that they have more inventory to buy for QE. Think about that. They need the treasury to issue treasuries so the Fed can buy them. Otherwise, they have no inventory to buy. I mean, it's mad. And, my response to that argument of look what Trump's done is we've printed $7.2 trillion in his 4 years here, and we've seen a GDP growth of 4.1 trillion. That's an organic loss of 3-point-something trillion dollars. And in some parallel universe, that's a good economy. I'll leave you with that. All right, everybody. Thank you very much, and we'll see you next time.